Hello and welcome to this first video of the lesson, Payments under a Life Insurance Policy. Here we will cover the following concepts. Let us begin by understanding the concept of claims. A claim is the legal demand or assertion by a claimant for compensation, payment, or reimbursement for a loss under a contract. The true value of a life insurance is judged by the way a claim is settled and benefits are paid. Claims can be of two types. Survival claims, which are payable even when the life assured is alive, and death claim. Examples of events triggering survival claims are maturity of the policy, an installment payable upon reaching the milestone under a money-back policy, critical illnesses covered under the policy as a rider benefit, and surrender of the policy either by the policyholder or the assignee. Now let us discuss how to ascertain whether a claim event has occurred or not. For the payment of a survival claim, the insurer has to ascertain that the event has occurred as per the conditions stipulated in the policy. For maturity claims and money-back installment claims, claims are easily established as they are based on dates which are determined at the beginning of the contract itself. For surrender value payments, the event is triggered by the decision of the policyholder or assignee to cancel the contract and withdraw what is due to him or her under the contract. And for critical illness claims, the assertion is based on medical and other records provided by the policyholder in support of his claim. Thank you. In the next video of the lesson, Payments under a Life Insurance Policy, we will discuss various types of claims. Here we will cover the following concepts. Let us first learn about the various types of claims whose payments may occur during the policy term. They are: first, survival benefit payments. Periodical payments are made by the insurer to the insured at specified times during the term of the policy. The policy bond is returned to the policyholder bearing an endorsement of payments made after each survival benefit installment. Second, surrender of policy. The policyholder opts for a premature closure of his policy. This is a voluntary termination of the policy contract. A policy can be surrendered only if it has acquired paid-up value. The amount payable to the insured is the surrender value, which is usually a percentage of the premiums paid. There is also a minimum guaranteed surrender value, GSV. Rider benefit is the payment under a rider, which is made by an insurance company on the occurrence of a specified event according to the terms and conditions. Under critical illness rider, in the event of diagnosis of a critical illness, a specified amount is paid as per the terms. The illness should have been covered in the list of critical illnesses specified by the insurance company. Under hospital care rider, the insurer pays the treatment costs in the event of hospitalization of the insured, subject to terms and conditions. The policy contract continues even after the rider payments are made. Maturity claim and death claim are the types of claims whose payments are made at the end of the policy term as specified in the insurance contract. In maturity claims, the insurer promises to pay the insured a specified amount at the end of the term if the insured survives the plan's entire term. The maturity value of the policy depends upon the type of policy taken by the policyholder. In case of participating plan, the amount payable under maturity claim is the sum assured plus accumulated bonuses, less dues such as outstanding premium, policy loans, and interests thereon. Return of premium plan. In some cases, premiums paid over the term period are returned when the policy matures. Unit-linked insurance plan, ULIP, The insurer pays the fund value as the maturity claim. Money back plan. The insurer pays the maturity claim minus the survival benefits received during the term of the policy. The insurance contract terminates after the claim is paid. Thank you. In this next video of the lesson, Payments under a Life Insurance Policy, we will learn about death claim. Death claim is the amount which is paid to the nominee or assignee when the insured person dies. A death claim marks the end of the contract as a result of death. The procedure for settling a death claim is relatively complex as compared to maturity claims. The nominee or assignee or legal heir has to intimate the insurer of the cause, date, and place of death. If the insured expires during the term of his or her policy, accidental or otherwise, the insurer pays the sum assured plus accumulated bonuses if participating, less dues like outstanding policy loan and premiums, plus interest thereon, respectively. A death claim may be early, less than 3 years policy duration, or non-early, more than 3 years. A number of forms are needed to facilitate the processing of a death claim. They are: claim form by nominee, certificate of burial or cremation, treating physician certificate, hospital certificate, employer certificate, certified court copies of police reports like First Information Report, FIR, Inquest Report, Post-Mortem Report, Final Report, which are required in case of death by accident, and death certificate issued by municipal authorities, etc., as proof of death. There are other terms that one needs to know in context of death claim. They are: repudiation of death claim. The death claim may be paid or repudiated. While processing the claim, if it is detected by the insurer that the proposer has made any incorrect statements or has suppressed material facts relevant to the policy, the contract becomes void. All benefits under the policy are forfeited. Section 45, Indisputability Clause. No policy of life insurance shall be called in question on any ground whatsoever after the expiry of 3 years from the date of the policy, that is, from the date of issuance of the policy, or the date of commencement of risk, or the date of revival of the policy, or the date of the rider to the policy, whichever is later. Presumption of death. The Indian Evidence Act provides for presumption of death in cases where an insured person has not been heard of for 7 years. In this case, court orders to the effect that the evidence of the person missing for 7 years should be obtained. On submission of the court order, the insurance company will process the claim. It is necessary that premiums should be paid until the court decrees presumption of death. Insurers may, as a matter of concession, waive the premiums during the 7-year period. Thank you. In this last video of the lesson, Payments under a Life Insurance Policy, we will discuss the claim procedure for the life insurance policy. Here we will cover the following concepts. The Regulation 8 of Protection of Policyholders' Interests Regulations 2002 provides claims procedure with respect to a life insurance policy. First, a life insurance policy shall state the primary documents which are normally required to be submitted by a claimant in support of a claim. Second, upon receiving a claim, one shall process the claim without delay. Any queries or requirement of additional documents, to the extent possible, shall be raised all at once and not in a piecemeal manner within a period of 15 days of the receipt of the claim. Third, a claim under a life policy shall be paid or be disputed, giving all the relevant reasons within 30 days from the date of receipt of all relevant papers and clarifications required. However, in case of a claim warrant, the investigation must be initiated and completed at the earliest. Fourth, subject to the provisions of Section 47 of the Act, where a claim is ready for payment, but the payment cannot be made due to any reasons of a proper identification of the payee, the life insurer shall hold the amount for the benefit of the payee, and such an amount shall earn an interest at the rate applicable to a savings bank account with a scheduled bank. And fifth, where there is a delay on the part of the insurer in processing a claim for a reason other than the one covered by Sub-Regulation 4, the life insurance company shall pay interest on the claim amount at a rate which is 2% above the bank rate prevalent at the beginning of the financial year in which the claim is reviewed. An agent must help the nominee or legal heir or the beneficiary in filling up of claim forms accurately and assisting in submission of these at the insurer's office. Apart from discharging obligations, goodwill is generated from such a situation whereby there exists ample opportunity for the agent to procure business or referrals in future from the family of the deceased. Here is a quick look at the topics covered in this chapter. Thank you.